What if I told you the greatest fortunes in history weren't made during times of prosperity, but during times of elapse? Not during the boom years. Not during the record highs. Not when everyone was celebrating gains. No, the biggest transfers of wealth happened in the moments the world fell apart. And what if I told you that the 2025 to 2026 market crises, the one economists whisper about but refuse to say on camera, might not just equal 1929, might not just echo 2008, but could surpass them both? But here's the question that matters most. If a historic crash is coming, why do the richest people in the world seem calm? Why are the billionaires waiting quietly? And why right now are the smartest investors accumulating assets while everyone else is panicking? Something is happening behind the scenes. Something that most people won't understand until it's far too late. Today, we're not just talking about a crash. We're talking about how crashes create millionaires while destroying everyone else. And the mystery is this: why does every financial disaster follow the same pattern? Why do the masses get crushed while a small group walks away wealthier than ever? To answer that, we need to rewind time back to 1929, 2008, and every crash in between. Because history doesn't repeat, but it does rhyme. And right now, the rhymes are getting louder. History, systems, and people who got rich during crashes. Before we talk about the future, before we talk about 2025 to 2026, before we talk about the opportunity window, we must look at the people who turned downturns into dynasties. The Great Depression, 1929, while millions lost their jobs, while markets collapsed by 89%, while banks failed, one man quietly grew richer, John D. Rockefeller. He increased his stake in industries at pennies on the dollar. He didn't time the bottom. He didn't guess the exact moment of collapse. He simply accumulated when others were afraid. The early 1980s crash and the chaos of inflation and interest rate spikes. A young investor named Warren Buffett bought American companies everyone else had abandoned. Those purchases became the backbone of Berkshire Hathaway. The dot-com collapse, minus 2000, while tech companies were burning to the ground. Jeff Bezos bought competitors, patents, assets, and digital infrastructure at fractions of their real value. Amazon exploded in value because he expanded aggressively during the crash. The 2008 financial crisis, this was the big one, the crash most people still remember. Housing collapsed. Banks crumbled. The global system cracked. And yet, hedge fund managers like Michael Burry saw it coming and prepared. Private equity firms bought real estate portfolios for cents on the dollar. Individuals who continued to invest quietly in index funds during the panic saw massive gains in the following decade. Why is this important? Because every single one of these fortunes came from the same formula. A bubble forms. The public gets excited. Smart money exits. The crash wipes out the unprepared. The patient, educated few buy assets at historic discounts. That's the pattern, always. And the question is, where are we in that pattern today? Origins of the 2025-2026 crisis, cause and effect begin. Let's trace the roots of the coming storm, because crashes don't appear out of nowhere. They build quietly, layer by layer, mistake by mistake. Root number 1. The post-2020 money flood after 2020. Governments worldwide injected over $30 trillion into the global economy. This wasn't free money. It wasn't harmless. It was fuel, jet fuel thrown on an already smoldering fire. Yes, it kept markets alive, but it also inflated everything. Stocks, real estate, crypto commodities, debt levels, government deficits, corporate borrowings, consumer spending driven by stimulus. The entire global economy was expanded like a balloon and, eventually, balloons pop. Route number 2, the hidden debt crisis. Governments kept borrowing. Consumers kept borrowing. Corporations borrowed more than any time in history. Debt is only safe when interest rates are low. But when rates rise, debt becomes a time bomb. Route number 3, the artificial tech. Boom AIEVs, biotech, robotics, incredible innovations, but overvalued stocks. Billions flowed into companies with no profits. Markets priced in perfection. And perfection is never sustainable. Route number 4, housing overvaluation. By 2024, housing affordability hit the worst levels on record in countries like the US, Canada, UK, Australia, New Zealand, Germany. Prices rose far beyond incomes. Interest rates made mortgages impossible. Sales slowed. Defaults increased. This is nearly identical to 2007, except now it's global. The build-up to the breaking point crashes always look calm before the storm. In the months leading to every major collapse, the same psychology appears. This time is different. We're in a new era. Technology makes old economics irrelevant. Markets always go up eventually. People said this in 1929. They said it in 2000. They said it in 2007. and they're saying it again today. Between 2023 to 2025, stocks hit exaggerated valuations. People took on dangerous levels of debt. Speculation surged in. Tech stocks, meme stocks, crypto real estate, fractional investing apps, leveraged unregulated trading platforms. It was the rise before the fall. And yet, in the background, insiders began selling. Institutions reduced risk. Hedge funds increased cash positions. The smart money was preparing. Every crisis has a moment where the system can no longer hold. Sometimes it's slow, sometimes it snaps overnight. The breaking point for 2025 to 2026 could be one or more of these. 1. A major debt default. A country, bank, or corporation could fail to repay loans. This sparks global panic. 2. A housing market freefall. If prices begin to drop sharply, millions could find themselves underwater on mortgages. 3. Corporate earnings collapse. Companies have been surviving on cheap debt for years. With higher interest rates, many cannot service their loans. 4. A liquidity crisis. When no one is willing to lend, markets freeze instantly. 5. Geopolitical trigger. Conflict or sanctions can destabilize energy, trade, and currencies. In all major historical crashes, the breaking point was not the cause. It was the spark that ignited the fuel built over years. What typically happens during a crash, this is where panic spreads. This is where the public gets hurt. This is where the wealth transfer accelerates. Historically, the fallout includes stock market declines of 30 to 60%, not all at once. Sometimes slowly, sometimes violently. Housing price drops, buyers disappear. Desperate sellers flood the market. Job losses, companies cut costs. Unemployment forced selling, people needing cash, sell investments at the worst possible time. Media fear cycle. News amplifies panic. Negative headlines deepen the crash. And while this happens, the wealthy prepare to buy. Not because they enjoy crashes, not because they're lucky, but because they understand the cycle. Panic gives discounted assets, gives future wealth. Why governments can't stop major crashes. Here's the uncomfortable truth. Governments can delay a crisis. They can soften it. They can hide it. But they cannot prevent it when the system has already overheated. Historically, failed fixes include 1. Printing more money. This works temporarily but leads to inflation months later. 2. Lowering interest rates. This makes debt easier, but encourages more borrowing and speculation. 3. Corporate bailouts. These protect large institutions but do nothing for the average person. 4. New regulations, often too late, implemented after damage is done. 5. Changing the narrative. Governments try to calm markets, but confidence is psychological. Once fear takes over, no speech can stop it. By the time these fixes are attempted, the wealth transfer is already happening. Shocking data and repeating patterns. Let's compare history to today. Parallels to 1929. Overconfidence in markets. Excessive leverage. Asset bubbles everywhere. Rising inequality. Speculation dominating fundamentals. Parallels to 2000. Tech stocks massively overvalued. Companies with no profits worth billions, retail investors rushing in. Late parallels to 2008, dangerous real estate valuations, unsustainable mortgages, globalized financial risk, debt markets reaching limits. Parallels to 1920s, inflation, stubborn inflation, high interest rates, falling living standards, commodities rising. Parallels to 2020 sampai 2022, stimulus-driven market growth, hidden fragility. Zombie companies dependent on cheap debt. These are not predictions. These are patterns. Patterns that have happened again and again. And when patterns repeat, outcomes rhyme. How people got rich during crashes. Let's look at the methods historically used by individuals who turned crashes into wealthy in ethical, legal, and strategic ways. Method number 1, buying undervalued assets during downturns. The best companies often fall with the bad ones. People who bought strong businesses during 1929, 1973, 2002, 2008, 2002, saw enormous long-term gains. Method number 2, accumulating real estate. Historically, those who buy homes or land during downturns benefit as prices recover, rents rise, inflation boosts asset values. Method number 3, investing consistently. People who simply kept investing monthly during crashes often outperformed those trying to time the bottom. Method number 4, building businesses during recessions. Some of the biggest companies today were founded in downturns. Uber 2009, Airbnb 2008, Microsoft recession of 1975, IBM panic of 1911, Disney Great Depression. Lower competition plus lower costs equals opportunity. Method number 5, acquiring skills others ignore in downturns. Skills become priceless. Sales, coding, automation, business strategy, financial literacy, marketing. AI productivity. Those with adaptable skills become What you need to do, these are not financial instructions, but historical guidelines that helped people survive and, sometimes, benefit from crashes. 1. Strengthen your cash position. Crashes create opportunities, but only for those with liquidity. This does not mean sell everything. It means reduce unnecessary expenses, build an emergency buffer, avoid high-interest debt. 2. Study market cycles. Most people lose money because they don't understand where the cycle is. Know the signs of boom, euphoria, denial, fear, capitulation, recovery. Knowing where we are helps avoid panic. 3. Focus on high-quality assets when everything falls. Strong assets survive and rebound. Historically, these include profitable companies, cash flow real estate, infrastructure, energy, tech leaders. 4. Don't chase hype. In every crash, speculative assets fall the hardest. 5. Invest in yourself. Skills outperform markets during crises. Educated individuals recover faster. Opportunities come to people who can adapt. 6. Think long-term. Crashes are temporary. Wealth built during crashes lasts decades. 3 clear takeaways. Takeaway number 1. Crashes are wealth transfers. Money doesn't disappear. It moves from the fearful to the prepared. Takeaway number 2. Patterns never lie. Every major crash in history began with the same ingredients: debt, speculation, overconfidence, and hidden fragility. The same ingredients are present today. Takeaway number 3. Preparation greater than prediction. You don't need to know the exact date. You only need to understand the cycle and position yourself intelligently. Final warning, plus open-ended thought. The 2025 to 2026 period may become the most important moment of your financial lifetime. Not because disaster is guaranteed, but because change is guaranteed. And in times of change, those who are informed, calm, patient, and strategic come out ahead. The question isn't, will there be a crash? The real question is, when the crash comes, what will you do? If you want to understand these cycles deeper, if you want more videos breaking down history's biggest crashes and the opportunities hidden inside them, then subscribe, turn on notifications, and let's decode the patterns together. Because the future doesn't belong to the fearful. It belongs to the prepared.